Well, good morning and welcome to a live cast on 50 ways to finance your startup venture. Thanks very much for joining. So I'm Bret Waters. I've been in Silicon Valley my entire career. I have been through this process 3 times of raising venture capital and building teams and running companies. And today I teach entrepreneurship at Stanford University. I coach startup CEOs at the Miller Center for Social Entrepreneurship, which is the leading accelerator program for social ventures. And we're super proud of the fact that our graduates have gone on to raise almost $750 million worth of capital. I also run a startup accelerator of my own called Fourthly, the Fourthly Startup Accelerator. And the first thing I want to say today is that you are all invited to our demo day for our female founder program on March 4th. We've got 10 really amazing women-led ventures and in our current cohort. And on March 4th, they will each do their 3-minute pitch. And it's an amazing group of women, amazing group of startups, and love to have you join us. So you can register for that at fourthly.com. So here's the thing I want to say today is that, for a lot of us who are startup entrepreneurs, and especially for those of us who live in Silicon Valley, it's easy to think that it's all about the venture capital, right? It's easy to get caught up in this notion that you have no self-worth unless you've been able to raise some venture capital. And so the main thing I want to kind of communicate to you today is that one of the great things about being an entrepreneur in 2021 is that there are so many different great ways to finance a startup business. And venture capital is one of them, but there are lots and lots of others. And so that's really the bottom line today in terms of what I'd like to communicate to you is don't get hung up thinking that your entrepreneurial dreams depend upon finding a venture capitalist who can hand you some yummy VC money, because there's lots and lots and lots of great ways to finance a startup business today. And of course, 95% of the successful businesses in this country have been founded and grown and thrived without raising any venture capital at all. So that's kind of the main thing that I want to communicate to you today. So before we start, just a couple of quick notes about some terms, can define a few terms. So venture capital is, venture capitalists are investing money from a fund, right? So venture capital firms, they go out and they raise a fund from a bunch of other investors. Some of them are individuals, some of them are pension plans and various other things. They put money into the fund, and then the general partner in the venture capital fund invests that money. And almost always that investment is in return for equity. So the venture capital firm is saying, I'm going to give you X number of dollars in return for Y percentage equity in your company, right? That's how that business works. It's how that business has worked for a long time. And it's a business that's basically based on binary outcomes. In other words, once a venture capital company invests in a firm, the expectation is that either it will be a big hit, meaning it'll have an IPO or get acquired by Google for a couple $1 billion, or it'll go bankrupt. Binary outcomes. It's either a $1 billion hit or it's bankrupt. And, out of every 10 investments that a VC makes, maybe if they're lucky, 2 will hit big and 8 will fail. And that's just the way that business works. Angel investors are individuals who are investing their own money. So typically that tends to be smaller amounts. And also typically that tends to be earlier stage, because since an angel investor is investing his or her own money, they can kind of make the leap of faith and just simply say, you know what, I believe in this person. This is interesting. I'm going to toss some money their way and see what happens. A venture capitalist can't really do that because a venture capitalist has a fiduciary responsibility to the limited partners who put money into the fund, right? So angel investors are individuals investing their own money. Venture capitalists are investing other people's money out of a fund. Fundamentally understand that there's debt and there's equity. So all capital that comes into an organization is either debt or equity, and there are pros and cons of each. It's not a matter of one being better than the other. There are pros and cons. And convertible notes and safes are frequently instruments used for early stage financings in Silicon Valley, seed stage. And a convertible note and a safe they're both conceptually the same thing, which is an instrument. It's an instrument that starts off as debt, in the case of convertible notes, and then converts at a later date to equity. So a convertible note is, as the name might suggest, it's a promissory note. So in other words, it's debt that converts to equity in the future based on certain triggers. A SAFE stands for Simple Agreement for Future Equity. It's an instrument developed by Y Combinator. It actually is not debt technically. It's simply an instrument that says that I can convert this in the future to equity upon these predefined terms. Okay, so there's our quick look at some nomenclature that we're going to be covering today. So as I said, there's lots and lots of great ways to finance a business in 2021. And let's kind of just plow through a few here. I know the other thing I was going to say is that I wrote a blog post to Medium a couple weeks ago with some examples of the great companies that have grown and succeeded without raising any venture capital. One of them is Zapier, who many of you probably know. It's an awesome software product that allows you to connect together multiple platforms. These guys raised some friends and family money and launched the company. And they've grown like a weed, and they're approaching $100 million in revenue now. Have taken zero outside capital. The reason I wrote the post on Medium the other day had to do with the fact that they were in the news because Sequoia, the big VC firm, wants to invest in them. And Zapier is saying, nah, we don't really need your money. And so Sequoia has been forced to buy some shares in the secondary market. They want so badly to get into it. Mailchimp is probably the world champion in terms of growing a successful business without venture capital. These guys, two guys, they had a marketing firm. They got tired of having to create email templates for their clients. And so they said, they've got to be a way to automate this. And so they created Mailchimp as a way of automating the creation of email newsletter templates. And they bootstrapped the thing all the way. And today it's a company that is approaching $1 billion in revenue. They've never taken a nickel of outside capital. And the two co-founders still own 100% of the company. It's pretty remarkable. Shopify's two guys who, I think it was three guys who wanted to launch an online snowboard store. And they didn't like any of the existing e-commerce software that was out there for building your own online store. And so they decided to write their own. So they wrote Shopify, they started selling it to others. And they grew it for 6 years without taking any outside capital. They finally took some outside capital. They're now approaching $2 billion in revenue. Github, those of you who are techies know all about Github. Again, bootstrapped for 4 years. Their first round of capital that they finally took was $100 million. That's pretty amazing when your first round is $100 million. And it's because they built the company the old-fashioned way for the first 4 years. And eventually, of course, sold it to Microsoft for $7.5 billion. Wayfair, another kind of famous company these days, bootstrapped and grown for 8 years. 8 years, they grew the company profitably with no outside capital. Finally raised some outside capital, and they had an IPO. They're now worth $30 billion. And my favorite example, my personal favorite example, is Farm Girl Flowers. Christina Stembel tried to raise outside capital. She was turned down by over 50 VCs on Sand Hill Road. Finally said, screw it. I'll just grow the company, myself, organically, if you'll excuse the pun. And she's now approaching $100 million in revenue, has taken zero outside capital, owns 100% of the business. So I give you all of these just as examples of successful companies that successful tech companies for the most part that have grown without venture capital. And again, I'm just trying to puncture the myth that somehow or another it's all about the venture capital, because it's not. There's lots of great ways to grow and to found and grow a company. So let's just plow through a few. So a very popular one, especially in the software business, is customer financing. In other words, let's say you have an idea for a software product, and you think to yourself, gosh, I'm going to need some financing to be able to, hire some folks to build this product. I don't have the money to do that. Well, go find a customer who'd be willing to pay you to build a custom implementation for them. And, it's often, especially, as I said, especially in the software business, you can often find a customer who's willing to pay $100,000 to build a custom implementation for them. And then you simply negotiate a deal such that they're going to pay you the $100,000. They're going to get the custom implementation, and you make sure you put into the deal the fact that you own the IP rights to what you're creating, and then you can productize it and sell to others. And so the financing of the first version, the financing of the initial version of your product was through a customer. Very popular, common, tried and true way of financing, especially startup companies, but others. Especially software companies, but others as well. And then kind of along with that is supplier financing. I once founded a company where a lot of the capital that we were going to have to raise was to buy some big, very expensive equipment from a particular company. And I was trying to figure out how the hell we were going to raise the money to buy this equipment. And one day I had a meeting with one of the execs at the equipment company. And he said, well, we'd really like to see you get going because it'd be good for us. So how about if we finance the original purchase of the equipment for you? And I said, well, that's an awesome idea. And that allowed us to get the company going with almost no outside capital, actually with no outside capital, because the biggest single ticket we needed to get going was the equipment itself, and the supplier was willing to finance that for us. Bank loans, of course, this is how businesses were started for centuries, was going to your local banker and borrowing some money. You won't be able to borrow a whole ton of dough for an unsecured personal loan in order to launch a startup, but you'll be able to get some money that way. And many, many, many businesses have started off that way. SBIR, Small Business Innovation Research Grants. So if you go to sbir.gov, you'll see that the federal government is very happy to fund your startup if it involves some sort of innovative technology that could be commercialized later. Go to sbir.gov, check out what they say there in terms of what they're looking for, what kinds of projects they'll fund, what their funding amounts are. It's a great way to get a startup off the ground. Create a SPAC. This is kind of a joke, honestly. It's pretty hard to, it'll probably cost you $500,000 in legal fees to create a SPAC. But SPACs, the reason I put it in here is that SPACs are all the rage right now, also called blank check companies. It's basically you form a shell company, and then you have an IPO with the shell company. And then once the shell company has all the money in there from the IPO, then you go spend that money on actually building a company, typically acquiring other companies in order to build a company. They are suddenly all the rage. And they're being used especially as a way of having an IPO without actually having an IPO. So rather than your company having an IPO, you create a SPAC, again, just kind of an empty shell company, have an IPO with that, and then with the $1 billion that's now in the bank account of the SPAC, then you acquire the target company. And so it's kind of a roundabout way of taking companies public. As I said, I just tossed it in there because in the news today, it's all about the SPACs. Impact funds. So this is one of the biggest changes that's happened in my career in Silicon Valley, is that it used to be that there was venture capital funds you could pitch for a for-profit company that fit the venture capital model, or there were foundations you could pitch on grants if you were a nonprofit business. But if you were a kind of a hybrid, if you were a social enterprise of some sort, a double bottom line company, as they say, being run partly for the economic profit and partly for the social impact, there was really nobody to pitch for that because you were not for-profit enough to pitch the venture firms and you were not nonprofit enough to pitch the foundations for grants. Today, there's a whole asset class called impact funds, kind of venture funds that have been raised specifically to have impact on a particular social area. So in other words, John Doerr at Kleiner Perkins created the New Schools Venture Fund specifically to invest in educational startups that would both provide some sort of modest return to the fund, but would also have a significant impact on K-12 education. And there's lots and lots of these now focused on various social issues, everything from poverty to education to environmental stuff. Impact funds are a great source of funding if you're a social venture. Double bottom line company, that kind of thing. Crowdfunding. So there's lots of these now, right? There's Kickstarter, there's Indiegogo, there's GoFundMe. There's a whole bunch of different crowdfunding options out there. And, you got to kind of check out what they do, because For example, Kickstarter, you can't really sell a startup equity on Kickstarter, but it's a great way to do pre-sales. It's a great way also to do fundraising for a creative project, a film or something of that sort. By the way, I want to pause for a second and say that I'd love for you guys to type in questions into chat. So any questions you have as I go along here, type them into chat, and I'll see if I can get to them. So crowdfunding. I mean, you all know about Kickstarter and Indiegogo and all like that. I think my favorite thing to do with crowdfunding. Oh, I should also mention Nextseed. So Nextseed is like a crowdfunding site. Well, it is a crowdfunding site, but it's specifically for businesses. So while there's some kinds of things that do not fit the Kickstarter terms of service, many of those things do fit the Nextseed terms of service. So check out Nextseed. My favorite thing to do with Kickstarter is pre-sales. And one of the best examples from history is the Peloton. That the founder of Peloton, he was trying to get his startup funded. He talked to a bunch of venture capitalists, and they just didn't get it. They said, you know, it's a stationary bike. It's an exercise bike. There's lots of exercise bikes out there. I don't see how this is a venture-worthy business. And he said, well, but it's got the big screen on it. We got the subscription, and we got the live workouts and stuff. And the VCs are like, nah, it's an exercise bike. I don't see how that's really a venture. I don't see how that has the economic leverage that a venture capitalist is looking for. And so what this guy did is he said, okay, I'll create a Kickstarter campaign. And on Kickstarter, I'll say, here's my prototype of what a Peloton will look like. If you would like to pre-buy one for $1,000, you can pledge here on Kickstarter to pre-buy one for $1,000. He got 300 people to each pledge $1,000 on Kickstarter, and that gave him the $300,000 to do the first production run, which then launched the company. And so, you know, pre-sales obviously only works on some kinds of ventures, but for something like Peloton, something like a hardware product, it's a great way to go. And the best thing about this, in my mind, is that there's always this chicken and egg problem where you go to talk to a venture investor, and the venture investor says, well, I'd be interested if you could show me market demand. And you say, well, how can I show market demand without actually building the product? And so you've got this catch-22, right? So in the case of pre-sales on Kickstarter, like Peloton did, you killed two birds with one stone. He both raised the $300,000 he needed for the first production run, and he proved market demand. Because if 100 people are if 300 people are each willing to give you $1,000 to pre-buy one of these things, that's pretty decent empirical proof of market demand, right? So I love pre-sales and that kind of thing. SBA, the Small Business Administration. If you go to sba.gov, you'll see they have all kinds of programs for helping small businesses get off the ground. They have a loan program. They have a equity capital program. They have grants for innovation. They have all kinds of things. This is your tax dollars at work, people. So check out sba.gov as a source of funding for your startup. Angel Syndicate. So I mentioned before that angel investors are investors investing their own money, typically kind of the smaller amounts, you know, 25,000, 50,000, 75,000 in that kind of range. Well, there are syndicates out there of angel investors who get together and say, you know what, this deal is going to need $1 million to get off the ground. How about if 20 of us put in 50 grand each, right? So I have here in the screenshot, Sandhill Angels. You can look them up. There are lots and lots of other angel investor syndicates out there. They can be a great way to get seed funding for your startup company. And then AngelList, angel.co, is a whole website dedicated to startups and dedicated to angel investors. And it's also a great way to find angel investors, to create angel syndicates, and get your company off the ground without formal venture capital. Marketing capital. So this is one of the more interesting trends that has recently appeared is, so every venture of every kind distills down to the notion that we have an ability to get a customer acquisition cost, for less money than what we could make from that customer. So customer acquisition cost needs to be less than the lifetime value of a customer. And once you've proven that out, once you've kind of proven that you've got the ability to get customers for a price of X and you can monetize those customers for a value of Y, then you kind of can plow as much money as you can get into your sales and marketing campaigns, because you have a proven way in which you turn $1 into $5, right? If your customer acquisition cost is $1 and every new customer you get, you can monetize for $5, then you basically have a machine that can turn $1 into $5. And so these new sources of capital have appeared in the scene, such as Clearbank, that invest specifically in that. So if you can prove to them that you have a positive customer acquisition cost against lifetime value of a customer, they basically give you as much money as you want in order to plow into your sales and marketing campaigns. And they charge you 6 points on that. So in other words, if you on $1 million, that's $60,000 that they charge you. And that's their way of getting around banking regulations, because it's not really interest, right? It's points on capital. And so it's not considered lending within the regulatory environment. And so it's non-dilutive capital, right? You're not giving away any equity. So you're basically funding your sales and marketing campaigns and paying 6 points on that capital, not diluting yourself at all. You're not giving away any equity. And so Clearbank and other newer funding sources like this, I think, have become a dramatically effective way for especially e-commerce companies and SaaS companies, where it's all about this simple customer acquisition cost against lifetime value of a customer equation. And then kind of related to that is revenue share financing. In revenue share financing, and there's a number of these out there, they give you money not for equity and not as debt. Instead, they give you money in return for a percentage of future revenue. So they might say to you, we'll give you $1 million in return for 5% of the future revenue of your company, or 5% of the future earnings in your company, up to some cap. Again, it's a really interesting kind of new way of structuring financing in a way that makes sense for a lot of companies. And Nextseed, which I mentioned before, has these. Nextseed often has deals posted that are revenue share based. I did one recently where it's I put $100,000 in, and I get 5% of the revenue of the company back until I get 1.5 times my capital back. And so I get 5% of the company, 5% of the revenue, until that adds up to 150,000 on my 100,000 in, and then I'm done. So for me, I got a 50% return. I'm happy. For the entrepreneur, they got the capital, and knowing that they gave away no equity, they took on no debt, and once that original capital is paid back at 1.5 times, then I'm gone. So again, interesting new way of structuring financing. Leverage your genetics, meaning that there are a lot of capital sources now that are specifically for female founders, or Black founders, or brown founders, or Latinx founders, or or LGBTQ plus, or whatever, right? There's a bunch of these out there. I've got numbers up here for Springboard, which is one of them that focuses on women. And so, if you happen to be somebody who fits one of these descriptions, then take advantage of it, because the competition often for funding from these sources is less than it is at traditional venture capital firms, because there are only so many, people whose ethnic background matches what this particular fund is interested in advancing. And lastly, respond to an RFQ. So RFQ is a request for quotation. If you go to the websites of many large organizations, my example one here is the United Nations. You go to the United Nations website, you go to the procurement section, and you will see a long list of the things they're looking for a vendor to do. And you might see something on there that you think to yourself, you know what, I could put together and build a team to do that. And if I do, they've got $250,000 in funding that they will give me in order to do that thing. And that'll give me the funding I need in order to get my startup off the ground, because that thing the UN wants to pay somebody to do is actually very much like the startup I'd like to create. So I did this myself once with an RFQ from the European Union looking for some software that would do a particular thing with throughout the European Union. And we didn't have a product that would do that. But I responded to the RFQ and said, basically, we could build you a product that would do that. And we got the deal. And we built a product that would do that. We got quite a bit of funding from the European Union associated with that. And then we got to keep the IP rights, which we could then productize and turn into products for our startup to sell. So again, my point here this morning is just kind of to open your eyes to the number of different sources and structures of capital that are out there for entrepreneurs in 2021. There's a lot. And, so spend some time on Google, spend some time looking at all these different sources, and spend some time thinking about what makes the most for your venture. And at the end of the day, it really is about aligning interests, right? It's about aligning interests between what the funder wants and what you want. And one of the ways in which traditional venture capital is often not aligned with a startup founder is that, as I said at the beginning, venture capital is all about, moonshots, all about, launching something that's going to go bankrupt or be $1 billion outcome. And that doesn't align with a lot of businesses, right? There are a lot of businesses where, I'd be very happy to grow this into a $50 million profitable company, right? If I can grow this thing into a $50 million profitable company that is employing people and having a positive impact on the world, I'll be a happy guy. Well, a $50 million company is just not of interest to a VC because you can't take that to an IPO and you're not going to sell it to Google for $1 billion. That doesn't mean it's a bad business. It just means it's not a fit for the venture capital model. And so, think about aligning your interests with investors' interests, and then think about which of all these various sources and structures that I've talked about here this morning are most likely to align your interest and the investor's interests. So let's see. So Richard has a question. Richard says, do you find that more people stick to one of these methods and explore that ecospace thoroughly and deeply, or do people explore different methods simultaneously? Well, first of all, I would say you should explore different methods simultaneously, right? So in other words, check into all of these and figure out which makes the most sense for your venture. And, frequently companies will end up with a hybrid. Frequently they will have raised some angel capital at the beginning, or maybe they raised some impact capital at the beginning, and then they raised some venture capital, and then they did a deal that was revenue share based. So frequently over the lifespan of a company, they'll end up exploring and leveraging several different sources of capital and such. Other questions? Anybody else have questions or thoughts you want to share this morning? I'm trying to think of what else I haven't covered. I have on my list here, borrow from your 401k. The reason I didn't cover that is that I hesitate to recommend that to anybody. As somebody who's approaching retirement age myself, I hesitate to recommend that you raid your retirement account. But it is a fact that not everybody knows that most 401k accounts are structured such that you can borrow against them. And so in other words, the capital remains there for your retirement, and it continues to grow across the investments that capital is invested in, but you've borrowed against it. The problem, of course, is that if you default on that loan, then that ends up being money that gets taken out of your 401k. So as I said, I hesitate to recommend that to anybody. Okay, so I think that does it for this morning. I tried to make it kind of short and sweet, but I'd love to hear from you all. So I'm pretty easy to find, Bret@fourthly.com, or on Twitter and Instagram and LinkedIn and everything else. I'm just simply Bret Waters, Bret with one T. So I'm super easy to find, and I'd love to hear you. We have a last minute question from Melody about leveraging your genetics. And Melody, you are the perfect one to talk about this. I actually know Melody, and Melody is very active in advocating for Latinx founders. And so Melody, that's what I meant by leveraging your genetics, is that there are a number of different sources of funding out there today that are specifically for Latinx founders, or specifically for women, or specifically for LGBTQ people, or whatever. And that's kind of a new thing, right? Capital that is specifically earmarked for a particular kind of underserved group that the investors who put money into that fund are interested in advancing. So we'll give Melody the last question. And again, thanks very much for joining, you guys. I'd love to hear from you. Send me a note. And most importantly, please attend the demo day for the Female Founder Program in the Fourthly Accelerator, Startup Accelerator. It's March 4th, 8 a.m. Pacific time. Go to fourthly.com to register. And I guarantee you won't be disappointed. We've got 10 amazing women-led ventures, and they're going to each give their 3-minute pitch. It should be a great event. So love to see you there. Thanks, everybody. See ya.